Hello, everyone. My name is Adam Remis, and I'm a CPA, been a CPA for nearly 27 years. I have a company called The Accounting Doctor, and we love to help clients save money on income taxes. That's what I've done over the last 27 years, and that's what I want to do for you. Today, we're going to talk about business deductions and opportunities that every business can consider and should consider. But first, throughout this entire presentation, I need to kind of refer to two different acts. One is the Secure Act 2.0, and that was signed into law in 2022. It had significant provisions from a tax treatment perspective for retirement plans, for capital gains, for everything that goes about when you think about tax planning for individuals and businesses. And the other one that I really want to talk through is what's called TCJA. It's called the Tax Cuts and Jobs Act. That went into effect about 5 years ago, but kind of rewrote things from a tax planning perspective. So if I refer to the Secure 2.0 Act or TCJA, now you have a better idea of what I'm talking about. So today, what I wanted to go through is just a few items from an overall business perspective. First, I want to talk about business structure, deductions, projecting your income, depreciation, and employee benefits. There's a lot of different pieces involved in each one of these. This is going to be more of a high-level conversation to really kind of drill down and understand how to organize your business from an overall technical perspective, C Corp, S Corp, partnerships, as well as looking for additional deductions from not only a deduction point of view, depreciation and employee benefits. So first, what I wanted to do is talk through business structure. For our clients, we love to see a combination of in the environment. Now you're thinking, okay, when you have a combination of a C Corp and you have an S Corp and then you have a Schedule C and you have a partnership, how are you going to keep things straight? Well, that's what you've got us for. We're here to help you keep things straight. Each one of these types of organizations can benefit you from a deduction point of view. For example, a C Corp is fantastic for employee benefits or for retirement planning expenses, but you can't do that over for an S Corp. A Schedule C is fantastic if you're trying to write off kids' expenses. So for example, for all of our clients, we absolutely love to have kids as we're working in the business. Even 2, 3, 4, 5-year-olds, well, they can be part of your advertising. They can be part and take that as a deduction of up to $13,000 for each kiddo. Well, if you've got 3 kids, now all of a sudden I'm looking at $40,000 deductions. I would place that as a deduction in the S Corp, add it in as income to the Schedule C, fine. The Schedule C gets wiped away because then you're dispersing the money to each one of the individual kids. You still get the deductions from the mom and dad perspective, but you get a huge deduction ultimately from the business. So having a C Corp, having an S Corp, having a Schedule C, having a partnership, all involved in different choices that you can make and different things that we can play around with is absolutely ideal and something that we do for almost all of our clients. One of the things that TCJA came out with is a 199A deduction. A 199A deduction is fantastic. It's basically used for pass-through businesses. So it's great for your S Corps and your partnerships. But the deduction can equate up to 20% of your qualified business income. This income is your total net income. Your net income is your revenue minus your expenses. That's your net income. Well, net income then flows to the individual owners. Okay, great. But TCJA gave you a haircut, a 20% deduction off that income. It's called a 199A deduction. We utilize that as part of our tax planning strategies as much as possible. Another idea, and then by the way, for the 199A deductions, there are some limitations and some things you need to think about. Typically, it's the greater of 50% of the amount of W-2 wages, or the sum of your W-2 wages plus 2.5% of your cost of qualified property. We kind of have to dig into these details. I'm not expecting you or anyone on this call to kind of really understand the details, but there is some technicalities to kind of implement the 199A deductions. Projecting income is something that we work with our clients all the time doing. We not only look at their 2022, 2023, 2021 returns, this is the last couple of years, but we also want to look at 24, 25, and 26. And the reason why we huddle with every client, not just at the end of the year, but really throughout the entire year, we huddle and have formal meetings with all of our clients at least 4 times a year. We do that because things change. As things change, well, your tax plan needs to change. And projecting income is a key component to what our advice would be based upon what your income might be in 24, 25, and 26. So projecting income is something that's very key to working with our clients. Accelerated depreciation, accelerated deductible expenses. There's a lot of creative things that you can do. For example, have you ever thought about having a cash basis entity being a S Corp or a C Corp, and then having an accrual-based entity also being an S Corp or C Corp? Well, things that you can do, cash basis, by the way, cash basis says anything in and out, you count. Accrual basis is more about what income is supposed to be recorded from an accrual basis versus the expenses that go out. So it's much more of what actually has occurred from either an economic or non-economic perspective. The cash basis is just simply, very, very simply, what's come into your checking account and what's gone out. Well, having different entities, having based on the cash basis versus accrual basis, these are different things that allow you to flex your muscles at the end of the day from a tax planning perspective, because you may want to put income in one but defer income on another. So once again, this is all about tax planning and things that we work with our clients on an ongoing basis. Depreciation is something that's a fantastic opportunity for a lot of our clients. I know you can dig into depreciation. Depreciation is a concept where if you buy a piece of machinery, well, IRS doesn't allow you to immediately take that full deduction. It stretches it over 4, 5, 6 years. Property improvements get stretched over 10 and 15 years, depending upon what they are. So thinking through what accelerated depreciation effects could be is absolutely key in tax planning. Because we work with our clients on an ongoing basis, consistent throughout the entire year, they are able to come to us and say, hey, Adam, I want to buy this truck for my business. Well, there's 2 different types of trucks that I want to buy. Which one should I buy? Well, there's limitations on some trucks that you can take as accelerated depreciation. Sometimes you can just write off the whole thing. Sometimes you have to depreciate it. We actually get involved in the client's businesses on an ongoing basis because we're there, we're in front of them. We're not just at the end of the year, actually the next year, looking backwards. That's, by the way, one of the big benefits that we have. For depreciation, there's a ton of bonus depreciation opportunity. This allows you to take the full amount of the depreciation in the current year. There are some limitations, especially through December 31st, 2026. It did allow the definition for accelerated depreciation to be expanded for qualified film, television, and theoretical theater-oriented productions. But once again, depending upon what you're doing, where you're going, we have to kind of analyze this and see, okay, what do you want to do with your business, and how can we do this from the best case tax savings perspective? Depreciation also, there's also a depreciation type called QIP. It's called qualified retail improvement. It's great for leasehold improvements, restaurants. This typically has a 15-year cycle, but also could qualify for what they call Section 179 depreciation expense, which allows you once again to accelerate those expenses. Ideally, we always think very simple. Let's defer taxes in every moment that we possibly can. So if that's deferring income, that's a win. If that's accelerating your expenses on the tax return, that's a win. These are big things that we think about each and every day for our clients. Employee benefits is something that we really look at to really analyze not only from a tax perspective, but what are you doing for your employees that differentiates your business from all the other competitors out there. It's a very competitive market from an employee base. You need to keep your employees. Well, things that you can do very quickly and easily are key life insurance plans, insert wellness plans that are extremely inexpensive and in some cases actually save you money from a FICA and Medicare perspective and gives benefits to the employees. And there's no cost to the business, no cost to the employees, and there's actually tax deductions that you get. These are the things that we work with our clients on over and over and over again. Another thing that we like under employee benefits is qualified deferred compensation plans. These are fantastic opportunities to basically lock in your employees, your key employees, for an extended amount of time. This works extremely well when the business owner wants to eventually leave the business, but then potentially think about who's going to stay. These qualified deferred compensation plans are really key opportunities. In addition to allowing you to have profit sharing, SEP, which is small business plans, pension plans, 401k plans, simple plans. These are all different types of deferred compensation plans that we look heavily into each and every day. Fringe benefits, I think I've mentioned before. I really like fringe benefits, but you need more of a C Corp. If you're just operating from an S Corp perspective, you can always pay marketing or advertising or management fees to your C Corp. That C Corp can then pay for those fringe benefits and get the full deduction. HSAs, FSAs, and HRAs, if you don't have them in your environment, you need to look and see if they're in your environment. Not only are they fantastic for the employees, but they're completely write-off deductions, and they're fantastic use from keeping the employees, and then also, more importantly, getting more deductions. That's all I have for you for this business-oriented tax planning session. We look forward to seeing you next time. Thank you very much for your time.